$1.5 trillion is the specific number that is keeping every regional bank CEO in America awake at night right now. This is not a theoretical projection or a random estimate from a bearish blog, but the hard data from the Mortgage Bankers Association. By the end of 2026, a massive wave of commercial real estate loans will mature and require immediate repayment or refinancing. The terrifying reality is that the vast majority of these loans cannot be refinanced because the underlying assets are now worthless. We are staring down the barrel of the largest default cycle in the history of the American banking system. If you want to understand how this debt wall impacts your savings and your local economy, you need to subscribe to this channel immediately. I am applying my 20 years of experience in institutional finance to break down this crisis without the mainstream sugarcoating. Hit that notification bell so you are alerted the moment the next critical update on this banking situation goes live. Please leave a comment below telling me which state you're watching from and if you have noticed empty office buildings in your city. I read through the comments to gauge the real ground level economic sentiment across the different regions of the United States. The core of this crisis lies in the fundamental difference between your home mortgage and a commercial real estate loan. When you buy a house, you typically lock in a fixed interest rate for 30 years, and your payment never changes. Commercial loans are almost always short-term instruments that float or reset every 5 to 7 years. The loans coming due in 2026 were originated during the absolute peak of the cheap money era in 2021. Back then, interest rates were near zero, and valuations for office towers and apartment complexes were at historical all-time highs. Banks were practically throwing money at developers, assuming that rent growth would continue to skyrocket forever. But today, the base interest rate has effectively tripled, and the value of those properties has collapsed by 40% or more. The math simply does not work for the borrower to get a new loan to pay off the old loan. This is what we call a maturity wall because it is a hard barrier that you crash into at full speed. Imagine you bought a house for $1 million with a loan that comes due in full today. But the house is now worth only $600,000 and the bank wants their $1 million back immediately. You cannot sell the house to pay the debt because you are underwater by $400,000. And you cannot get a new loan because no bank will lend you $1 million on a $600,000 asset. This is exactly what is happening to thousands of office buildings and multifamily syndicates across the country right now. The owners of these properties are simply mailing the keys back to the bank and walking away from the deal. They are choosing a strategic default because it makes no financial sense to throw good money after bad. This transfers the problem from the real estate investor directly to the balance sheet of the lending bank. The bank is now the proud owner of an empty office building that requires millions in maintenance and pays no rent. This asset, which was listed as a safe, secured loan on their books, is now a massive liability. And the scary part for the American public is who exactly holds this toxic debt in their portfolio. It is not the massive, too big to fail banks like JP Morgan or Bank of America that are most exposed here. Those giants saw the writing on the wall years ago and significantly reduced their exposure to commercial office space. The bag holders are the small and mid-sized regional banks that serve your local communities and small businesses. Data shows that regional banks hold nearly 70% of all commercial real estate loans in the United States. These are the same banks that provide the credit lines for your local dry cleaner and restaurant and contractor. When these banks take massive losses on real estate, they invariably tighten lending standards for everyone else to survive. This creates a credit crunch that strangles the real economy even if you have nothing to do with real estate. We are already seeing the early signs of this liquidity freeze in the data for small business loan approvals. But the regulators in Washington have been allowing these banks to play a dangerous game called extend and pretend. For the last 2 years, banks have been modifying these loans to avoid marking them as non-performing assets. They have been letting borrowers pay only the interest or extending the maturity date by a few months. They were hoping that interest rates would crash back down to zero and save the valuations of the collateral. But as we move deep into 2026, it is clear that rates are staying higher for longer. The Federal Reserve is more concerned with fighting inflation than bailing out bad commercial real estate bets. This realization has forced the regulators to start cracking down on the extend and pretend accounting gimmicks. They are now demanding that banks mark these assets to their true market value, which is often zero. When a bank marks an asset down, it takes a direct hit to its capital reserves, which protect depositors. If the capital reserves fall below a certain regulatory threshold, the FDIC is forced to step in and seize the bank. We saw a preview of this movie in 2023 with Silicon Valley Bank and First Republic Bank. But the scale of the problem in 2026 is significantly larger and more systemic in nature. We are not talking about a few tech-focused banks making bad bets on Treasury bonds this time. We are talking about hundreds of community banks that are fundamentally insolvent due to their loan books. The collateral damage of this maturity wall is already visible in the downtown districts of major American cities. San Francisco and Chicago and New York are filled with zombie buildings that are physically standing but financially dead. These buildings are generating zero tax revenue for the cities, which relies on them to fund public services. This leads to a secondary crisis where municipal governments face massive budget deficits and must cut services. Police and fire and sanitation budgets are being slashed because the property tax base has evaporated overnight. It is a doom loop where the city deteriorates, causing more people to leave, which further lowers property values. The finance guys in New York call this a negative feedback loop, and it is notoriously difficult to break. But the most dangerous aspect of this crisis is the obscurity of the private credit market involved. A significant portion of this debt is held by non-bank lenders and private equity funds that are unregulated. These shadow banks do not have access to the Federal Reserve discount window if they face a liquidity run. They are entirely dependent on investor confidence and the ability to raise new capital from wealthy individuals. If a major private credit fund freezes withdrawals, it could trigger a panic that spreads to the public markets. We are seeing redemption requests spike at major real estate investment trusts as investors try to get out. The liquidity mismatch in these funds is a ticking time bomb that few people are discussing publicly. They own illiquid buildings that take months to sell, but they offer investors quarterly liquidity. When everyone rushes for the exit at the same time, the gate slams shut and the money is trapped. This $1.5 trillion wall is not just a problem for the rich developers and the bankers on Wall Street. It is a deflationary force that sucks capital out of the economy and destroys wealth at a rapid pace. When a bank fails or a fund freezes, it destroys the confidence that makes the entire monetary system work. Money is ultimately a construct of trust, and that trust is being tested by this massive wall of debt. The average depositor assumes that their money is safe because of the FDIC sticker on the door. But the FDIC insurance fund has nowhere near enough capital to cover a systemic collapse of regional banking. They would need to print trillions of dollars to make depositors whole, which would reignite inflation instantly. This puts the Federal Reserve in an impossible position between saving the banks and saving the dollar. They have to choose between a deflationary depression caused by bank failures or hyperinflation caused by printing. The maturity wall of 2026 is the catalyst that forces them to make this impossible choice. The smart money sees this coming, and they are positioning themselves accordingly by moving to safety. They are moving cash out of regional banks and into systemic banks or directly into short-term treasuries. They are avoiding commercial real estate investment trusts and looking for assets with no counterparty risk. The complacency in the general public is alarming, considering the magnitude of the numbers we are seeing. People are still acting as if the banking crisis was a one-time event that was solved years ago. They do not realize that the underlying cancer of bad debt was never removed, it was just ignored. Now the cancer has metastasized, and the patient is running out of time and treatment options. The commercial real estate market is effectively frozen, with transaction volumes down 70%. Nobody knows what anything is worth, so nobody's willing to buy or lend on these assets. This price discovery phase is painful, but necessary to clear the market of the bad debt. Until the prices come down to reality, the banking system will remain in a state of paralysis. And while the banks are paralyzed, they cannot fuel the growth of new businesses and ideas. This is why we call it a zombie banking system that walks among us, but cannot create life. The $1.5 trillion coming due is just the tip of the iceberg of the total debt. There are trillions more in corporate debt and consumer debt that will mature in the coming years, but commercial real estate is the first domino to fall because of the post-pandemic shift in work. The structural change in how we use office space has permanently impaired the value of these assets. It is a secular shift, not a cyclical one, which means the values are not bouncing back. The denial phase is over, and the acceptance phase is beginning to set in across the industry. Bankers are finally admitting that they have a problem and that the problem is too big to hide. The earnings calls of these regional banks are becoming confessionals of their bad lending decisions. Stock prices of the most exposed banks are being punished by short sellers who smell blood. This market discipline is brutal, but it is the only mechanism that forces the truth to the surface. As we move deeper into this year, the headlines will be dominated by bank seizures and mergers. You will see familiar names on the branches in your town change overnight as they are absorbed. The consolidation of the banking industry into a few megabanks is accelerating rapidly now. This centralization of financial power has profound implications for the future of American capitalism. Small businesses will find it harder to get a loan from a faceless algorithm at a megabank. The personal relationship banking model is dying along with the balance sheets of these regional lenders. We are witnessing the end of an era in American finance and the birth of something new. But the transition period will be marked by volatility and uncertainty for everyone involved. The $1.5 trillion bill has come due, and there is no money in the account. The mechanics of this default cycle are brutal and unforgiving for everyone involved in the transaction. When a commercial loan matures, the borrower typically gets a new loan to pay off the old one. But in 2026, the math for that new loan is fundamentally broken by high interest rates. To qualify for a new loan today, the building must generate enough income to cover the higher payments. But because office vacancy is at record highs, the income from these buildings has actually gone down. So the bank tells the borrower that they can only lend them 60% of what they owe. This creates a funding gap where the borrower must bring millions of dollars of fresh cash to the table. This is called a cash in refinance, and it is the kiss of death for most real estate investors. They do not have $5 million of cash sitting around to save a dying office building. So they refuse to put good money after bad, and they let the building go into foreclosure immediately. This forces the bank to take ownership of an asset that they have no expertise in managing. Banks are in the business of lending money, not managing skyscrapers and fixing elevators and finding tenants. When a bank takes over a building, they immediately slash spending to stop the bleeding of cash. This leads to a rapid deterioration of the property, which drives away the few remaining tenants. We are seeing this play out in real time in cities like St. Louis and Baltimore and Minneapolis. Entire city blocks are becoming ghost towns as the zombie buildings rot from the inside out. This is not just a problem for the rich landlords, it destroys the local economy around the building. The coffee shops and the delis and the dry cleaners that serve those workers go out of business. The tax revenue that the city collects from that property collapses as the value is written down. This brings the crisis directly to your front door in the form of failing municipal services. When the city collects less property tax, they have to cut the budget for police and fire and schools. You start to see more potholes in the road and longer wait times for emergency services. This is the urban doom loop that economists have been warning about for the last 3 years. It is a slow-motion train wreck that accelerates as more buildings hit the maturity wall. The impact on the residential housing market is less direct but equally dangerous for homeowners. Regional banks are also the primary buyers of mortgage-backed securities in many local markets. When they are bleeding cash from commercial losses, they stop buying residential mortgages entirely. This removes liquidity from the housing market and makes it harder for you to get a home loan. It pushes mortgage rates higher, even if the Federal Reserve cuts the official Fed funds rate. The spread between the Treasury yield and the mortgage rate widens as banks demand a risk premium. This creates a frozen housing market where buyers cannot afford to buy and sellers cannot afford to sell. But the most terrifying aspect of this year is the contagion risk to the shadow banking sector. A massive amount of commercial debt was packaged into securities and sold to pension funds and insurance companies. These are the institutions that hold your retirement savings and your life insurance policies. They chased yield during the low interest rate era by buying risky commercial mortgage-backed securities. Now, those securities are being downgraded to junk status by the rating agencies across the board. This forces the pension funds to sell them at a loss because they are not allowed to hold junk. This forced selling drives the price of the debt even lower, creating a self-reinforcing death spiral. We are seeing A-rated tranches of commercial debt trading for 60 cents on the dollar. That implies a level of catastrophic loss that the financial system is not capitalized to absorb. The regulators know this is happening, and they are quietly trying to ring-fence the toxic assets. But the sheer size of the $1.5 trillion wall makes it impossible to contain fully. You cannot hide an elephant under a rug no matter how hard you try to distract the public. The narrative in the media is that this is a contained event limited to a few bad actors. They want you to believe that the system is sound and that your money is safe in the bank. But the insider data on loan delinquencies tells a completely different story of systemic rot. Delinquency rates on office loans have doubled in the last 6 months alone and are accelerating. This is the leading indicator that the maturity wall is hitting with maximum impact right now. Borrowers who held on for years hoping for a rate cut are finally throwing in the towel. They realize that the higher for longer regime is not a temporary policy, but a new reality. The capitulation of the borrowers is triggering the liquidity crisis at the regional banks. When a bank has too many bad loans, they must raise capital by selling stock or assets. But nobody wants to buy the stock of a bank that is loaded with toxic commercial real estate. So the bank stock price crashes, which scares the depositors and triggers a digital bank run. In the age of mobile banking, a bank run can happen in seconds, not days or weeks. Billions of dollars can leave a bank in an afternoon with a few swipes on a smartphone. This speed of failure gives the regulators almost no time to react and organize a rescue. They are forced to use the systemic risk exception to bail out uninsured depositors repeatedly. But every time they do this, they debase the currency and create more moral hazard. They teach the bankers that they can take reckless risks, and the taxpayer will foot the bill. This cycle of privatization of gains and socialization of losses is breaking the social contract. The average American is struggling to pay for groceries, while the bankers get bailed out again. This anger is building up in the populace, and it will have political consequences in the future. But for now, the financial consequences are the ones that you need to navigate carefully. The credit crunch is already squeezing small businesses that rely on regional banks for working capital. If you run a small business, you know exactly what I'm talking about with line of credit cuts. Banks are sending letters reducing credit limits or canceling lines of credit with zero warning. They are hoarding cash to prepare for the losses they know are coming from the real estate portfolio. This stifles the real economy and leads to layoffs in the construction and manufacturing sectors. It is a recession that starts in the balance sheet of the bank and ends in the unemployment line. The construction industry is particularly vulnerable because they rely on construction loans to build. New starts for commercial projects have fallen off a cliff because no bank will lend on them. This means that the construction workers who build offices and apartments are losing their jobs. These are high-paying blue-collar jobs that support families and drive consumption in the economy. When those workers stop spending, the retail sector takes a hit and the recession deepens further. It is the ripple effect of the $1.5 trillion rock thrown into the economic pond. The waves wash over every sector of the economy, eventually, no matter how safe you think you are. Even the tech sector is not immune because they are the biggest tenants of office space. Tech companies are paying millions for empty offices they leased during the boom years. They are trying to sublease the space, but there are no takers in this market at any price. So they are taking massive write-downs and laying off employees to cut costs and survive. The interconnectedness of the modern economy means there is no safe harbor from this storm. You cannot just ignore the commercial real estate market because you do not own an office building. Your bank owns it, and your pension fund owns it, and your insurance company owns it. And because they own it, you are exposed to the losses that are crystallizing this year. The valuation reset is necessary, but it is painful, and it will take years to work through. Prices need to fall to a level where it makes economic sense to buy and operate the buildings. But that clearing price is likely 50 or 60% below the peak values of 2021. That amount of wealth destruction wipes out the equity of the owners completely and hits the debt. When the debt takes a hit, the lenders take a hit, and the banking system wobbles dangerously. We are in the early innings of this write-down phase, and the worst is yet to come. The volume of maturities peaks in the second half of 2026 and stays high. This is not a one-quarter problem. It is a multi-year slog through the mud of bad debt. The smart money is waiting on the sidelines with dry powder to buy the distressed assets. They are waiting for the banks to capitulate and sell the loans for pennies on the dollar. This transfer of wealth from the banks to the distressed debt funds will be historic. But in the meantime, the chaos will create volatility and uncertainty for the average investor. You need to understand that the rules of the game have changed and the old strategies fail. Buying the dip on regional bank stocks is like catching a falling knife in this environment. Yield chasing in high dividend real estate trusts is a recipe for capital destruction now. The dividend is often paid with debt, and when the debt cuts off, the dividend goes to zero. We have seen this happen with major rates already, and there are many more to come. The trap is set for the unsuspecting investor who looks at the yield and ignores the risk. You must look at the debt maturity schedule of every investment you own in this market. If they have a massive debt wall coming in 2026, you need to sell before the crash. The market is inefficient and often slow to price in the existential risk of refinancing. You have a window of opportunity to exit before the crowd realizes the math is broken. But that window is closing fast as the maturity dates get closer every single day. The borrowers are running out of time and options, and the banks are running out of patience. The grand standoff between the lenders and the borrowers is ending in a wave of liquidation. And when the dust settles, the landscape of American cities and banking will be changed forever. The ultimate endgame of this banking crisis is not a mystery to anyone who studies financial history. When the banking system faces a solvency crisis of this magnitude, the government only has one tool left. They cannot fix the bad loans because the buildings are physically empty and the value is gone forever. They cannot force tenants to move back into offices when remote work is cheaper and more efficient. So the only option remaining is to paper over the losses with a massive flood of newly printed money. The Federal Reserve will eventually be forced to lower interest rates to save the banking system from collapse. They will do this even if inflation is still above their 2% target, because the alternative is worse. The alternative is a deflationary depression, where ATMs stop working and credit cards are declined everywhere. No central banker wants to be the one presiding over the next Great Depression in the history books, so they will choose the path of least resistance, which is to sacrifice the value of the dollar. They will cut rates and restart quantitative easing to buy the toxic assets from the bank's balance sheets. This will transfer the losses from the bank shareholders to you, the holder of US dollars. You will pay for this bailout through higher prices at the grocery store and the gas station. It is a stealth tax that is levied on everyone who holds currency instead of hard assets. The purchasing power of your savings will be diluted to fill the hole in the bank capital reserves. This is why the stock market often rises during a banking crisis, which confuses many novice investors. The market is not rising because the economy is good. It is rising because the currency is collapsing. Stocks are priced in dollars, so when the dollar falls, the nominal price of the stock goes up. This creates an illusion of wealth, while the real standard of living for the average person declines. We are entering a period of financial repression where the government keeps rates below inflation. They do this to inflate away the real value of the debt over a long period of time. It is the only mathematical way to deal with $38 trillion of federal debt and bank losses. But there is a darker risk that you need to be aware of regarding your bank deposits. In 2010, the Dodd-Frank Act was passed to prevent future taxpayer bailouts of banks. It introduced the concept of a bail in where the bank creditors are forced to take losses. The problem is that, legally speaking, a depositor is an unsecured creditor of the bank. When you deposit money in a bank, it is no longer your money, it is the bank's money. You hold an IOU from the bank promising to pay you back when you ask for it. If the bank fails, and there is a bail in your deposit, could theoretically be converted into equity. This means you would wake up one morning owning stock in a failed bank instead of having cash. While this is unlikely for insured deposits under $250,000, it is a risk. For amounts over the insurance limit, the risk is very real and has happened in other countries. We saw this happen in Cyprus during their banking crisis, where depositors took a massive haircut instantly. Small business owners are particularly vulnerable because they often keep payroll cash above the limit. If your payroll account gets bailed in, you cannot pay your employees and your business stops immediately. This is why you must diversify your banking relationships and never keep all your eggs in one basket. You should have accounts at multiple banks to maximize your FDIC insurance coverage protection. You should also consider moving excess cash into short-term U.S. Treasury bills for safety. Treasuries are backed by the full faith and credit of the government directly, not a bank. They currently pay a higher yield than most savings accounts and are exempt from state income taxes. This is the risk-free rate that the banks are trying to capture for themselves with your money. By buying treasuries directly, you cut out the middleman and eliminate the bank counterparty risk. You become your own central bank, and you take control of your own financial destiny. The consolidation of the banking industry is another trend that will accelerate during this crisis. The government is effectively encouraging the big banks to swallow the small, failing regional banks. They want a system with a few massive institutions that are easier to regulate and control. This moves us closer to a European-style banking system with very few choices for the consumer. It reduces competition, which means higher fees and lower interest rates paid to savers long term. It also centralizes the power to deny credit based on political or social criteria in the future. If there are only 4 banks in the country and they all blacklist your industry, you are dead. This centralization of financial power is the greatest threat to economic freedom in our lifetime. The small community banks were the backbone of American entrepreneurship, and they are being wiped out. They knew their borrowers personally and would lend based on character, not just a credit score. The algorithms at the megabanks do not care about your character or your standing in the community. They only care about the data points, and if you do not fit the box, you get denied. This depersonalization of banking is a tragedy that is unfolding alongside the financial crisis. But you can still vote with your money by supporting the healthy community banks that remain strong. Not every regional bank is loaded with bad commercial real estate debt in this environment. Some were conservative and avoided the temptation to lend on speculative office towers and condos. You need to do your due diligence and read the balance sheet of the bank you use. Look for their exposure to commercial real estate as a percentage of their total capital. If the number is too high, you should move your money to a safer institution immediately. There are websites and services that analyze bank health and give them a safety rating. Use these tools to protect yourself because nobody else is going to do it for you. The Federal Reserve and the FDIC are reactive institutions that only step in after the crash. They will not warn you in advance because they do not want to trigger a panic. You have to be proactive and read the signs that the market is sending you right now. The yield curve inversion and the commercial foreclosures are the flashing red lights on the dashboard. The market is screaming that something is broken, and you need to pay attention to the warning. The $1.5 trillion debt wall is the catalyst that exposes who was swimming naked. As the tide goes out, we are seeing which banks were reckless and which were prudent. The reckless ones will fail or be acquired, and the prudent ones will survive and gain share. But the turmoil in between will cause volatility in the stock market and the real economy. You should expect tightening credit conditions to slow down consumer spending and business investment. This creates a recessionary environment where cash is king and liquidity is premium. In a deflationary credit crunch, the person with access to cash can buy assets for pennies. Real estate prices will eventually bottom out and create a generational buying opportunity for investors. But you have to survive the crash to take advantage of the recovery on the other side. This means paying down your own high interest debt and building a robust emergency fund. You do not want to be forced to sell your assets at the bottom to pay bills. You want to be the buyer at the bottom who is picking up the pieces from the wreckage. The transfer of wealth during these crises is always from the indebted to the liquid savers. Be on the right side of that transfer by preparing your balance sheet today. The government will try to inflate the debt away, which means you need inflation hedges too. Gold and silver and quality real estate are assets that have historically preserved purchasing power. They are the insurance policy against the currency debasement that is coming to save the banks. The policymakers have painted themselves into a corner with no easy way out of this trap. They have to choose between a collapse of the banking system or a collapse of the currency. History shows that they will always choose to sacrifice the currency to save the institutions. They will print as much money as it takes to keep the ATM machines working. This is the lesson of 2008 and 2020 and every crisis before. The playbook does not change because the incentives of the politicians and bankers do not change. They kick the can down the road and make the problem bigger for the next cycle, but eventually the road ends and the can hits a wall that is 1.5 trillion high. We are at that wall right now, and the impact is being felt across the entire system. You cannot control what the Federal Reserve does or what the regional banks do. You can only control your own exposure and your own reaction to the unfolding events. Do not be paralyzed by fear, but be motivated by the need to protect your family. Take the steps to secure your deposits and hedge your portfolio and reduce your liabilities. Education is your best defense against the financial repression that is being engineered. The more you understand about the banking system, the less you will fear its inevitable failure. You will see it as a predictable cycle rather than a random act of misfortune. Thank you for watching this 3-part deep dive into the commercial real estate debt crisis. We have covered the numbers and the mechanics and the solution to this massive threat. If you found this series valuable, please subscribe to the channel and share it with someone you care about. The algorithm suppresses this kind of truth, so we rely on you to spread the message. Leave a comment below with your thoughts on where you are moving your money to be safe. I will be reading your comments, and I look forward to seeing you in the next video. Stay safe and keep stacking, and never trust a banker with your financial future.